There's one number that tells you exactly when everyone is wrong. PCR stands for put-call ratio. It's a simple division. Total open interest of all put options divided by total open interest of all call options on an index like Nifty or Bank Nifty. Puts are bought by people positioning for the market to fall, whereas calls are bought by people positioning for the market to rise. So PCR is basically a scoreboard of fear versus greed. A PCR around 1 means puts and calls are roughly balanced. The market has no strong directional bias. A PCR above 1.3 means traders are buying far more puts than calls. They are probably scared, they are hedging, they are expecting a fall. A PCR below 0.7 means traders are loading up on calls. They are greedy, they are chasing, they are expecting a rally. Now here's where it gets interesting. PCR is a contrarian indicator, which means high PCR is often bullish and low PCR is often bearish. Exactly opposite of what it looks like. Why? Because by the time the crowd is heavily one-sided, most of the move has already happened. When everyone has bought puts, there's no one left to sell, so the market has nowhere to go but up. And when everybody has bought calls, the next move is usually a sharp fall because the only thing now left is profit booking. Experienced or pro traders usually use PCR as a temperature check. Combined with price action, OI buildup and India wicks, it tells you whether the market is leaning too far in one particular direction. It's not a prediction, it's a positioning map. So the takeaway is that market rarely rewards the crowd. PCR is just one of the simplest ways to figure out where the crowd is standing so that you can decide whether you want to stand with them or step aside. Save it so that you remember to check PCR before your next setup and share it with someone who still treats PCR as a signal. Don't forget to follow Nubra for more.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.